Good day, investors. I am your host, Jared Bowers. We've had a lot of new listeners over the past few weeks. So if you're new here, welcome. And if you would be kind enough to let me know how you came across this, I would love to hear from you. You can email me at feedback@vestedjb.com. And if you do, I bet you'll hear back from me. And just so you know, the back catalog of episodes isn't that long yet, and they are all quite evergreen. So I hope you go give them a listen as well. Okay, as we continue digging into the big brick investment concepts applied to both money and to life, I want to make clear that we are still laying an important foundation. 18 episodes in and still laying a foundation? Yes, because this isn't some fly-by-night philosophy or short-term investment. We have a lot to cover in the future, and so much of what we are going to explore beyond this early stage is going to be built on these concepts. And my goal and intent is that you learn the important things, the big brick concepts of portfolio management, and then are able to apply them, not just to money, but to all those areas of life we care about. And when it comes to the areas of life that we care about, we care a lot about risk. Specifically, managing risk. More specifically, preventing or limiting downside risk. As a brief disclaimer, this episode will have a bit more of a financial investing bent to it. And I'll probably use a little bit more of that jargon related to risk as a result. Coming on the heels of our episodes on diversification, which I hope you were pleasantly surprised at how many non-money areas were the focus in those episodes, this one has to focus a bit more on the money side to make sure that we're on the same page. We're still going to talk a lot about life, and our next episode will be back to applying all of this much more on the life side of the portfolio. And to start out our discussion on risk and downside, I would like to ask you to imagine two very different lives. One, highly volatile, lots of ups and downs, good times and bad times, hard times and easy times. The other life, very stable, very few peaks and troughs, a smooth glide path. Which one feels safer to you? That should be easy to identify. The stable life definitely feels safer. In contrast, the ones with ups and downs feels riskier. But now my next question for you. Which life would you rather have? This smells like it might be a trick question, doesn't it? If I'm answering this question, myself, I know what I should choose based on what I know and my life experience, but I also know what I probably would choose if no one was looking or listening. Because if I'm being honest, it would be really hard to not choose that stable path. Most of us, including me, live our lives and talk about our lives in a way that makes clear that we would much rather have that smooth and stable life that is devoid of most ups and downs. A lot of my life has been spent thinking that the point is to be on a smooth glide path. Reduce friction, reduce volatility. Have things just be good and safe. All the times that I've told myself, once this is over, once I accomplish this, once I finish struggling through this, I will have achieved the point of it all. To coast. To take it easy. This is natural, and it is built into all of us. Why go the hard route when an easier one is available? Well, the answer is in what we are trying to accomplish and what we want our life experience to produce. That very important question that we keep coming back to. For what purpose? I asked you what you might rather have, but now I would like to ask you to think about when you've grown as a person. The seasons where you have made the most progress. The periods that have resulted in the most forward movement. The lessons that you'll never forget. If I were a betting man, I would bet a lot of money that nearly every one of those times of growth was during a period of struggle, a period of uncertainty, a period of sadness, a period of hard. Not all those experiences at one time, but likely at least one of them: a period of volatility. Compare that to the times that you remember things being pretty stable and calm and simple. Think about a time like that you had in life. Aha! You probably remember that time in general, but you don't remember much about it, except that it was pretty calm and stable. Because not much will stand out when you think about it. Not much learned, not a whole lot experienced. Few things that really anchor our memories. More often than not, those are times where we didn't experience much growth. Those calm and simple times are nice, and I'm certainly not saying that we shouldn't have them or seek them out. But we have to give our past an honest look, apply our tracking and measuring tools, remember the bias of our flawed memories, and benchmark our progress in those volatile versus calm periods. If we do that accurately, you'll probably come to the same conclusion that I have. If all I had were the easy times, I would not be the person that I am. I would not have grown. Honestly, without struggle, I think I'd be a pretty worthless person. The only parts of me that can be described as worth much were shaped through challenge and struggle and volatility. The times when the markets were out of whack, when life was throwing me curveballs from multiple angles, with kids, with career, with my health, the growth in my relationships through shared challenge, hard conversations, helping friends through hard times or friends helping us through hard times, taking on leadership roles and responsibility before I felt ready. The seasons where I constantly felt stretched were also the seasons where I changed and grew the most. So, is volatility a bad thing that we should work to minimize? Those volatile times feel risky. And shouldn't we be working to eliminate or at least reduce risk in our lives? Yes, I think we should be working to reduce risk. Now, am I talking out both sides of my mouth? Reducing or eliminating risk is the right thing to do. Thinking that volatility, the ups and downs, represents risk is where we go wrong. We grow through volatility, the ups and downs. If you've ever lifted weights consistently, you already understand this intuitively. Muscles grow by applying controlled strain followed by recovery. Soreness is not failure. It's what results in adaptation. If you tried to eliminate all discomfort from your training, you would eliminate nearly all progress too. If we do everything we can to remove it from our lives, we may limit our downside, but we also limit our upside. This is a poor approach to investing in many cases. If we can, we want to reduce downside while preserving or enhancing upside. And that is what we're going to talk about today. Identifying and managing risk. Much of what we've talked about already has touched on, or at least has been related to, risk. In asset allocation, we talked about the importance of choosing our risk rather than letting life choose risks for us. In our recent conversations on diversification, we talked about how diversification does not eliminate risk, but it does help us manage it. In our episodes on tracking, measuring, and benchmarking, we learned how to identify and manage risks and make adjustments to get better outcomes. In deposits and withdrawals, we covered that if we overdraw an account of money or an account of life, we expose ourselves to increased risk. Risk is something that we want to manage and we want to reduce, yes. But to do that well and successfully, we need to understand what risk is in the first place. And what represents risk for one person may not be seen as risk or as risky to another. It's important that we are able to identify the risks in our lives we want to manage and avoid. And we want to make sure that we aren't labeling something as risk that's actually a necessary ingredient in what we are trying to accomplish. A key part of the returns that we're trying to invest toward. Many of us have fallen for this when it comes to volatility, the ups and downs. We're tempted to see it as synonymous with risk. You might be able to thank the investment profession for that. Hold that thought for now. So let me define risk as simply as I can. Risk is the likelihood of permanent loss in something that we value. And there are two parts to that. There's the downside as we define it, how bad can it get? And then there's the probability of that downside. How likely is that bad outcome to happen? And if we can accurately identify those two parts, we have our measure of risk. Again, with risk being the likelihood of permanent loss in something that we value. And defining, identifying, and measuring risk accurately is really important. Because once we identify it, we can work to remove it, avoid it, or minimize it. And that's what we should do with risk, right? Minimize it? Yes. The answer is yes. That wasn't a trick question. Because when we apply the correct definition of risk, the likelihood of permanent loss in something we value, there isn't a benefit to that type of risk. There is only benefit to reducing it. And if we identify the wrong risks or the wrong things as risk, we are going to be working to reduce or minimize it or take it out of our portfolios, which might actually backfire if we've identified the wrong thing. And on the flip side, if we fail to identify true risk, then that risk may be present and building in the background until it emerges and results in that permanent loss that we want to avoid. Now, as we like to do, to frame all this, let's talk about risk as it applies to financial portfolios. The most common measure of risk that is used in financial markets is volatility. Volatility is the traditional, most typical, most common measure of risk in financial portfolios and financial assets. By the way, my entire formal education in finance and investing tried to teach me that volatility, the thing I just told you is not a good measure of risk, is the main measure of risk that we should pay attention to. Problematic. We'll talk about volatility even more in the future, but here we will start to get familiar with the concept. And again, just to make sure that we're on the same page, volatility is, quite simply, how much something goes up and down. Think of the zigzag of stock price movements, those ups and downs on a daily, weekly, monthly basis, as the volatility that we're talking about. The mathematical representation of volatility is most often calculated, measured, and expressed as standard deviation. Standard deviation is basically a measurement of how far something typically moves away from its average. If the price usually stays close to its average, the standard deviation is low. If it swings far above and below its average, standard deviation is high. That is useful information. It's just not the same thing as risk. I'm not going to explain how standard deviation is calculated. That may be something we do down the road because of how much fun it would be. No, I'll likely never do that. Don't worry. We're not going to go through the mathematical calculation of standard deviation, so it's safe to keep listening. Just know that volatility is a terrible way to measure risk. And I will explain why. You will not be confused about my stance on this by the end of the episode. I am opposed to using volatility as the main, or even as a very important measure of how risky something is in most cases. Because volatility doesn't tell you much other than how much something goes up and down. And when you apply that to financial markets and you use that as your main measure of risk, you are going to come to some bad conclusions. Consider the fact that financial markets are not very rational in the short term. They overreact to both good and bad news. The markets overreact even to speculation about good and bad news, even before that good or bad news actually happens. There is a lot of mispricing in the markets, especially in the short term. Prices that are too high or too low. That is just a matter of course in financial markets. Most people recognize and agree with this. So using volatility as the key, as the main measure of risk, when it is based on irrationality and overreaction, doesn't make a lot of sense to me. Again, all volatility tells us is how jumpy short-term traders are when it comes to that specific asset, or that specific asset class overall. It doesn't tell you anything when it comes to financial investing about the fundamental underlying strength of the investment. Imagine evaluating marriages this way. One couple never argues, never pushes each other, never deals honestly with conflict, seemingly very stable. Another couple has hard conversations, challenging seasons, stress, challenge, shared purpose that requires a lot of effort, but more volatile. Which one is actually stronger? Which one is actually safer long term? Using volatility as your measure of risk, a company that is vastly overpriced but has a stable price will be considered less risky than a company that is vastly underpriced but has big price swings. Stability and safety in a company has very little to do with price and very much to do with its fundamentals. That would be the strength of its balance sheet, its cash flow, the trajectory of its earnings, its likelihood of being able to survive a downturn, its ability to capitalize on opportunity. Those are the things that would tell us something useful about the risk of an investment in a company, right? And as it relates to volatility in times of uncertainty, and especially in times of panic, everything tends to move up or down together. Cheap and quality is sold right alongside expensive and garbage when panic selling sets in. At the same time, during periods of euphoria and excitement, and what I refer to as panic buying, this also happens. Overpriced, low-quality companies fly upward in price right alongside underpriced and high-quality companies. Something that we're going to unpack and cover many times as we move forward from here is that prices in the short term are set by supply and demand. More sellers means that the price is going down. More buyers means that the price is going up. That is what drives markets in the short term. And factors that affect short-term supply and demand are things like fear, greed, excitement, rumors, speculation. This is a crucial relationship to understand. The supply and demand relationship that determines prices. But keep in mind, this is only for the short term. But we care a lot more about the long term, don't we? Yes, we should. And in the long term, prices are determined by fundamentals. Actual underlying business results. How the companies are actually doing. The real tangible outcomes of customers actually served. Products and services actually sold. And ultimately, and most importantly, the profits that the companies, eventually do or do not earn. There's a famous Warren Buffett quote on this, that in the short term, the market is a voting machine, and in the long term, it is a weighing machine. This is what he meant. The votes are the buys and sells of the traders in the market on a daily, minute-by-minute basis. More sellers than buyers, the price goes down. More buyers than sellers, the price goes up. That is the voting mechanism that rules the markets in the short term. The scale used to weigh the companies in the long term is not looking at the votes. It's measuring what is actually there. Show me the money. Show me the actual profit and cash flow, and I will tell you how much the company actually weighs, how much it is worth, regardless of the short-term voting. Even if the price label on it suggests that it weighs something different in the short term, those price labels will be pulled towards the actual weight in the long term. Because there is often a difference between price and value. Life works this way too. In the short term, popularity is determined by image, charisma, confidence. Those things get votes. But over the long term, people get weighed. Character gets weighed. Competence gets weighed. Consistency gets weighed. A lot of fundamental investing is becoming familiar with and adept at gauging the weight, the value of an asset, and then comparing the number attached to it, the price tag. If you go to your favorite store and an item that you are very familiar with is mislabeled with a much lower price than it should be, because you know the value of it, you might take that up to the counter and have the clerk do a price check. And if they tell you, yeah, this really is the price today, you're going to buy it. Similarly, if you see a price on something that is way too high and you know it is, you're going to walk right past it and not bother. You won't be tempted to think that the actual value is what the price label says, because you know the value. You're not going to be suckered into paying too high a price for it. It's no different when it comes to companies. I've practiced my entire adult life at figuring out the value of things. And when I see a price attached that doesn't make sense, I can take action. Price is what you pay, value is what it's worth. Only sometimes do those two match. But as we're talking about risk today and unpacking volatility, we won't get too much deeper into that until we talk about fundamentals and valuation in a future episode. Back to volatility. Using volatility to measure risk for a financial investment would be like using mood to determine someone's value. Some of us are stable as she goes. We don't change that much in terms of our mood or our affect, but some of us are a lot moodier. I am, admittedly, quite moody in comparison to Alicia, who is quite steady. A very nice trait to have in a spouse. Too bad for her. But to be fair, compared to other people, I know I'm pretty darn steady. There's that comparison game rearing its head a little bit. But even the moody people that I know, most of them, aren't riskier just because they are sometimes down and sometimes up. They aren't dangerous. They aren't worth less or live riskier lives. They, like everyone else, tend to be on a trajectory. Some of the very stable and steady people I know are on a flat or even negative trajectory. They're just steadily on that trajectory. They're comfortable, predictable, but slowly shrinking. Less curious, less capable, less useful, less invested. Little volatility, but also very little growth. Does that make them less risky? And some of the more volatile, more moody people that I know are on a very positive upward trajectory. Does that make them less safe? And that trajectory is mostly set by the investments that we are or are not making. Now, our moodiness as individuals might impact our volatility around that trajectory line. It might make progress slower or faster at times, depending on our mood, our affect, but most of the time, that variation around the trend line is not the most important part. What is the most important part is the direction of that trend line. Again, moodiness may affect the movement around the trend line, but it doesn't determine the direction. And what is setting that direction in the first place? Going back to financial portfolios and volatility as a measure of risk, I would like you to imagine 3 investment trend lines with similar volatility. Now remember, the volatility is just the ups and downs, the peaks and troughs that intersect a trend line. Imagine the first trend line as steadily upward and to the right. That would be a positive return trajectory, right? Moving forward in time with positive returns. Then imagine the second trend line as a steadily straight rightward but flat line, not up or down, sideways. That is moving forward in time without returns, a flat line. Then imagine the third trend line, but down, trending downward and to the right. That is a trending line of loss. Okay, we have our 3 lines. Now, over the top of each of those trend lines, imagine jagged V's, W's, up and down, and you can draw those W's intersecting each of those trend lines and make those jagged ups and downs the same magnitude, the same height, intersecting each of those trend lines. So your first line is jaggedly up and down, but trending upward to the right, trending gains. Your second trend line is jaggedly up and down, the same magnitude as you go along, straight to the right, no returns. Your third trend line, of course, is jaggedly up and down, but trending downward, trending loss. By the measure of standard deviation, which is the main measure of risk in financial markets, because those peaks and troughs are the same size in all 3 cases, they go up and down in the same magnitude in the short term, standard deviation would tell you that line A, the upward trending line, is equally as risky as line B, the sideways trending line. But what is even more crazy is that standard deviation would also rate line A, the upward trajectory, as equally risky to line C, the third line, the one that is jaggedly downward and to the right, the trending loss. That doesn't make a lot of sense to me. Same jaggedness, different direction. Same volatility, but not the same risk. Now, to be perfectly precise, the trend line itself still doesn't tell us everything. Even the direction of the line doesn't tell me which is riskier. The one going up could be way too expensive, and the one going down could represent something that is really strong, but really cheap. I would still need to know the fundamentals underlying each. I need more information. But what I do know is that the size of the bounce is not enough to tell me the risk. But each of these 3 companies would be measured as the same level of risk because that is what the math shows. Those jagged ups and downs, those jagged peaks and troughs, the volatility that is measured is going to spit out the same number. Standard deviation of X for all 3. Therefore, equally risky. But not, as you can see, because volatility is a bad measure of risk, especially on its own. Now, if we did have more information, and to demonstrate even further how bad volatility is as a measure of risk, consider the company on a downward price trend is going down because it has really poor fundamentals, but almost no volatility. Very little jaggedness around the trend line. Just very steady drops in value over time, driven by a steady deterioration in its profitability. Then consider the company that is on the upward trajectory, is going up and to the right, is going up because of strong fundamentals, but it has big price swings up and down. In this case, the perpetually losing company would be measured as safer than the perpetually winning company, as measured by the most common and widely used measure of risk, volatility. I hope it is clear by now that this is not a good way of measuring things. That is going to result in bad decisions if volatility is your main measure of risk. And I should point out that the reason that finance people like to use volatility as the preferred measure of risk is because it is quantifiable. We can actually assign a number to it. And in finance, we love things that we can assign a number to, that we can calculate. It makes us feel really good when we can get to a number and say, that's the number, that's the measure, because we don't like uncertainty. Uncertainty feels risky, and we like to be able to certainly say that this is the risk of the company, this is the risk of the fund, this is the risk of the market, because we can calculate a number for it. But I don't think you need more convincing that volatility is a bad measure of risk. Because what is volatility? Volatility is motion. Risk isn't motion. Risk is fragility. Volatility tells you how jumpy the price is. It doesn't tell you how fragile the asset is. And what is necessary to get returns? What's necessary to make progress in anything? Motion. Movement. Progress is forward or upward movement. And rarely do ups come without downs. Oh boy, that kind of sounds like volatility. Because it is. Consider this. There's a lot of risk in a lack of motion, isn't there? Think about someone who stops taking risks entirely, stops applying for things, stops learning. They stop meeting people. They stop trying. They don't ever risk embarrassment. Their life becomes very stable and very small. That stuckness that we've talked about before. Without motion, we can't get returns. We can't drive anywhere that we want to go. Returns are forward motion, upward motion. Rarely does upward motion come straight and steady. Temporary downs are part of that upward movement over time. Volatility is noise. It's simply information that we can choose how to respond to. Most of the time, we should ignore it. Sometimes, we should respond to it with a well-reasoned purchase or sale as a response to the opportunity that volatility presents to us. Risk, on the other hand, is structural. Flat and smooth can be more risky than jaggedly up and down. This is true in fitness. Soreness is volatility. Heavy breathing is volatility. Fatigue is volatility. Those things may feel bad in the moment, but they are not risk. Injury is risk. A body that can no longer do what you want to do is risk. A body that deteriorates over time because of a lack of movement is risk. And ironically, avoiding all the soreness, all the fatigue, all the discomfort may be the most direct path that leads to risk with your health. I may have described volatility this way before in a past episode. Volatility is the waves, the blips, the ups and downs on the heart rate monitor of life. Zero volatility is a flat line. You do not want to flatline on the heart rate monitor. Volatility does matter. And we're going to talk more specifically about that in an upcoming episode. But remember, it is a terrible measure of risk on its own. So, what is a good measure of risk? A true measure of risk? Well, in financial investing, I define a good measure of risk as the likelihood of permanently losing capital. That fits directly into how we identified risk at the beginning of this episode, the likelihood of permanent loss in something that we care about. Now, the problem with this, even though I believe it is a much better measure of risk, is that it is hard to quantify. We can't boil it down to a single number that we can calculate on a spreadsheet like we can with standard deviation. My definition of risk is much harder to assign a single number to. How do you accurately quantify the likelihood of permanently losing value? It would be a triangulation of 3 or more figures related to financial strength, profitability, and future growth trajectory, which are all themselves triangulations of different measures and metrics that are all impacted by company-specific and overall market factors. But isn't that ambiguity and difficulty consistent with the existence of risk in the first place? Thinking that we can assign an objective number to risk is a bit like assigning a color to each flavor that we taste, or a feeling to each smell. It might give you an idea of its directionality, but it misses most of the mark. In this case, that it is risk, and therefore, at least partially unknown and unquantifiable. It's still worthwhile to consider risk from this standpoint and try to figure it out to determine what it is. It is hard to measure, but once we do, it's easier to control for. I'll give you an example of how I accurately measure this in my work as a portfolio manager. Because it's not just one thing, it's a combination of many factors. I measure risk on financial strength, profitability, growth, customer demand, competitive advantage, and management alignment. I'm looking for things that make a company hard to kill and likely to grow. For the strength of their balance sheet, ideal is low levels of debt that are easily serviceable with strong cash flow. I look for whether a company is in a growing business in a growing industry, as that can mitigate a lot of downside. Growth covers a multitude of problems. I look at margins, measures of their profitability, and of course, I like to see them strong and expanding. I want to invest in companies that are getting more profitable as they get bigger, which means the company is capturing and achieving economies of scale. They can deliver their product or service cheaper, better, faster as they grow. I look for companies that have a product or service that customers really want, that they would notice if it disappeared because it's not easily replaced with substitutes. I look for investments with competent management teams with skin in the game. They are bought into their own company with the majority of their net worth in the stock of the company that they manage. And ideally, with a manager that was a founder. Skin in the game is crucial because they are going to be aligned with me as an investor, as a shareholder. That means that the decisions that they make for the company are going to affect them and me and my clients the same. Really, those directions should affect them more than they affect me and my clients because we don't have the majority of our capital invested in any one of them. Now, all of these things that I mentioned, and that's just a sampling, they have nothing to do with the volatility of the company's price, the ups and downs. But they have everything to do with understanding, managing, and reducing real risk. And the more important side of the equation, the opportunity. Let's say we're looking at two companies. Company A checks all the boxes that I mentioned, but it is highly volatile. Its stock price swings up and down a lot. And company B checks none of those boxes, but its stock price is quite stable. Very little movement up and down. Company A will be viewed and treated by finance people, analysts, and most portfolio managers as risky. They will label the fundamentally weak company that has a more stable price as less risky than the fundamentally strong company that has a more volatile price. And I hope you can see how absurd that is. Let me pose this question to you. What would you like to have your portfolio made up of? Unprofitable, low growth, low potential companies that all happen to have very stable prices, or highly profitable, high growth, high potential companies with safe balance sheets, but are very volatile in price. The price moves up and down. I think I can guess which one most of you would choose, and you are right. You would choose the same thing I would. And that would be the profitable companies with more price fluctuations. And you and I would be picking companies that are riskier according to the popular measures of risk. And you, my friends, just identified yourselves as fundamental investors. Congratulations. Because we care a lot more about the things that make up the value rather than just simply the price and the price changes. Yes, I keep going on about this, that volatility is a bad measure of risk. But it is because it is ingrained. It's an established idea that needs to be dispelled. Not just with money investments, but with life investments. We tend to view the ups and downs of life as bad. As we talked about at the beginning of this episode, we really don't like volatility. And we seek out and try to get stability. But if we misidentify what is risk and focus solely on reducing volatility, we will get poor outcomes. In life, risk is the same definition. Risk is the likelihood of permanent loss in something that we value, not the ups and downs that we experience. And we will dig into upsides and downsides in life in much more detail in the next episode. Now, we should talk briefly about expected returns, because these are related to risk. Before we make an investment, we should be asking ourselves, what are we looking to achieve from this? How likely are we going to achieve it? That's what I mean by expected returns. And we should have proper expectations going in. Because so much of achieving satisfaction and avoiding disappointment in investing and in life is having proper expectations. That doesn't mean low expectations, it means appropriate ones. Expected returns inform how much we should invest and how much risk we should be willing to take. More risk is not always required for more returns, but it is generally true directionally. Investments in money and in life that have higher expected returns will many times come with higher risks. Most of the time, investments with higher expected returns will also tend to have higher volatility as well. But thankfully now we understand volatility as a poor measure of actual risk. But that volatility can chase people away from investments that have higher expected returns. Knowing what we are likely to experience going in will help us avoid responding badly when faced with the reality of the risks that might manifest. We want to have appropriately aligned investments aligned with our goals, with our purpose. A high-risk, low-reward investment is not aligned. If you look at something and you know that it's going to be risky by real measures of risk, not just volatility, yet it has low expected return, that is misalignment. So we should gather the information and do the analysis to understand the potential returns that we can get from an investment, the returns that we expect to get from an investment that we make, and the likelihood that it will pay off. And we can use a decision matrix for what to pursue and what to avoid. And it is a very simple decision matrix. In the show notes online for this episode, I will have this decision matrix in it. And you can find a link to the website in the episode description. In one quadrant, you have low expected return and low risk, low downside and low upside. You're not going to get much growth. That's fine for stability if that's the goal. You may or may not choose to invest in that, but it is not necessarily an irrational investment decision to go for low risk and low growth. That would be something like treasury bonds. Low risk, low return can be an appropriate investment. In another quadrant, you have low expected return and high risk. Low upside, high downside. That would be the never invest quadrant. Does not make any sense to ever allocate to low expected return with high or catastrophic downside. I sometimes have clients or friends or family who are excited about an investment opportunity that has been shrewdly marketed to them. The peddler of the investment gets them excited about huge potential returns without ever acknowledging the risk. It could be a brand new pre-revenue company, an unproven technology. This is also most private equity that is marketed to retail investors. In those cases, I have to be the one to explain to them that this is high risk and low expected return. And they are being sold something, not being given an opportunity. In the third quadrant, you'd have high expected return and high risk. High upside, high downside. It would not be irrational to invest in this quadrant if you can bear the risk and if the expected returns are high enough. If it is sized appropriately and if it is part of a diversified portfolio intentionally invested in, just because it has high risk or high downside does not make it wrong to invest in, assuming it has appropriately high expected returns. This could be something like starting your own business. Yes, risky. Yes, high potential payoff. And then you have that fourth quadrant, the place that we are all shooting for, that we are all trying to achieve. High expected returns, low risk. High upside, low downside. Those investments fall into the definitely pursue, absolutely invest in category. And we do have opportunities to invest in this magic quadrant all around us. Don't believe me? Let's talk about some of the examples of low downside, high upside investments. The first is with money. Investing in profitable and strong companies that are already well established, that represent good value. This is what I'm confident I have in my portfolio for myself and my clients. Some volatility, sure, but investing in leaders in their industry that are highly profitable and have fortress balance sheets. That's a very high upside, low downside proposition over time. Another easy example is investing in our health. With good nutrition, appropriate movement, the downside is very small and the upside is enormous. Same with investing in quality relationships. The downside is we might be hurt or offended by the people that we love sometimes, but the upside is a big part of what makes life worth living. And the upside is usually much greater. Investing in education is another example. Huge upside with limited downside. It's hard to even come up with downsides of investing in education, except maybe sometimes we wasted our time or energy or money. But that is often a lesson in itself. All of these cost us something, yes, but they should. High upside, low downside doesn't mean that they are easy or cheap. It means that they are worth making investments into. So, should we be walking around with this decision matrix in our pocket? Yeah, I think we should. Maybe not literally in our pocket, but we should have it in our heads, and we should be looking for ways to apply it. We should be considering, if we're making an investment, where does it rank from high to low expected returns? Where does it rank from high to low risk? Likelihood of permanent loss, downside, versus likelihood of gains, upside. We sometimes pursue high risk, low reward investments because they feel good in the short term. Investments with an instant payoff, but high long-term cost. We're going to dig into that in the next episode. Or we get ourselves stuck by mostly staying in that low volatility, low reward quadrant that feels safe, but really just has limited upside. We often avoid the magic quadrant in the decision matrix, the low risk, high reward quadrant, because it has something that smells like risk but isn't: volatility. So consider, where are you investing on that decision matrix? Do you have some low returns because you're confusing volatility with risk? Are you living in that comfort zone of perceived safety with very little volatility? Do you have some big losses because you haven't identified the right risks with big downsides and low upside? And on the other side, do you have areas that you invest in that have highly volatile returns, but you know are not risky because they align with your purpose and what you are working to accomplish with your investments? I hope so. And those areas, once identified, are often great candidates for getting more of our investment resources. So as you look across your portfolio of life, don't just ask what feels volatile. Ask what is fragile, what could break, what could result in permanent loss. And then ask the harder question: where am I avoiding volatility and accidentally increasing risk, or sidestepping returns that are there? Maybe that conversation you need to have feels risky. Maybe applying for the role feels risky. Raising your hand feels risky. Maybe starting the business feels risky. Maybe investing in the market feels risky. But maybe the real risk is becoming the kind of person who never moves, is stuck, because movement feels uncomfortable. But it might not actually be risky. It might just be something you're avoiding. We live in the safest time in human history. Historically, taking a chance often meant literal survival risk. Today, for most people, risk usually means embarrassment, discomfort, uncertainty, rejection, or temporary setback. Taking appropriate and measured risks has never had less downside. What is the bigger risk? Being down sometimes in an otherwise upward and to the right trajectory, or limiting your trajectory? And that is what we will talk about more next time. Okay, thank you for investing in yourself and in those around you. I will talk to you next time. The ideal investment that you can be offered is one that goes straight up and to the right forever with no downside, right? You want to know another name for that? A scam.